All right, you guys, this is being recorded. Something I mention at the beginning of every single webinar, and it sounds like a broken record, I'm sure, but watch this video again. Whether it's this synthetic short stock or another synthetic short stock video that I've done, watch it again relatively soon after this, because what happens is some of the nuances that I talk about, especially if you're newer to options trading, may go right by you. And the second time through, you'll catch all those little nuances. And another thing is, it will sink into your long-term memory. You'll be able to remember it much longer if you watch it relatively soon after. If you wait a month or video or a month or down the road, it's going to be like learning it all over again. So please watch another one or this one right away, because I think that will help you throughout this webinar or throughout your trading regimen. KM said we got audio visual okay, good. She knows I mess up, or KM knows I mess up every once in a while, and we have issues at the start of some of these. So good to know that we got that out of the way. All right, this is going to be on the synthetic short stock. And one thing I forgot to mention is feel free to reach out in the questions box at any time, because you guys really drive the content. I want to make sure you're clear a concept before we move on. So feel free to reach out there with any comments or questions, or if you see I'm saying something wrong. All right. So, or if I misspeak, I should say. All right, synthetic short stock. This is going to be a little bit different than some of the other videos, because I want to talk about, we all have a portfolio out there, whether it's a 401k, you can manage some of your risk in your trading account to your 401k through these different options strategies, okay? And we're going to be talking about specifically how to implement these into a portfolio. With the synthetic short stock, it's not a full-on portfolio of shorts. You know, we're going to be doing very small amounts of this, but there's always a bear market out there in something. You know, I mean, we're seeing right now headline news on Boeing, the treasury market coming off with the stock market at all-time highs. So all of those things can be taken advantage of with the synthetic short stock strategy. And the benefits outweigh the negatives using synthetic short stock than just going out there and shorting a stock. I'll go through all of those benefits and the downside of it as well. So without further ado, let me get on with a couple of things, get them out of the way. My name is Eric Wilkinson, and you very well may recognize me from mainstream media as the Wolfman, where I used to talk about everything from economic to geopolitical and market analysis. I do all of that stuff now in my daily market commentaries so that you guys can get access to that. Follow us on Facebook. That's one of the easiest ways to do it. I actually started out trading in college with some money I had earned, and I started out with a psychology degree and started trading, and then decided to switch it over to finance. After finance and graduating with that degree, I moved to Chicago straight away for a summer job, and ended up growing roots and stayed there for about 25 years. And in that time, I've traded everything from stocks, financial futures, commodity futures, and products or options on all these products in just about all market conditions. I got to go over this disclaimer really quick. Basically, it says anything I talk about in these webinars and or daily market commentaries should not constitute investment advice. The reason why it shouldn't constitute investment advice, you guys, is because I don't know what's in your risk or what your risk parameters are. I don't even know what's in your portfolio. So it would not be a fiduciary responsibility of mine to give you investment advice. As a matter of fact, it would be completely the opposite. So take what we teach you in these different webinars and in the daily market commentaries and implement it into your portfolio in your own way. Remember, past performance of any trading system or methodology is not necessarily indicative of future results. At the end of the day, I could have very different market outlooks than you guys, and you might very well be right. So make sure you don't let me talk you into something different. All right, you can follow me on Twitter at Wolfman's Blog, or our parent company at ProTraderStrat. And then on Facebook, where we throw out a lot of content that is, you know, as close to the minute as we can get. I shoot the video and we push it out onto Facebook. So, you know, we get it to you a little bit quicker than you finding it in an email somewhere or in your spam folder. Who knows where it comes out. But if you go to Facebook or follow us on Facebook, you'll be able to get access to that relatively quickly. And that's at protraderstrategies.com. You can find us there. All right, before we get on with the short stock or the synthetic short stock here, I want to talk about a couple of things about options, that a lot of people find difficult to understand in the beginning. And I want to give you a couple little ways to think about these things that will make it a little bit easier for you. And delta is the effect of an option premium in relation to the underlying's first dollar move. That's pretty simple. Delta actually tells us a lot of different things. But one of the things we're really going to talk about here in this market commentary is how it is going to affect an option premium. So the easiest way to do that is pull up a platform here. Let's delete that trade there. And take a look at the options montage. We're going to go over to all of the Greeks here. So we've got delta, gamma, theta, and vega. And I'm going to go over all these really quickly. But what this basically is telling us is that on the first dollar move is what we're interested in. So basically, we are looking at XYZ stock, and in this case, it's Gilead Science. But what that first dollar move means, whether it's higher or lower, okay? So if Gilead goes to $67.76 and goes up to $68.76, what that's telling us is down here in these options premiums that this delta, 34 cents, will increase by 34 cents over here in our premiums, okay? So it's going to go from basically, let's call it middle of the road, 110. So if we say it's at 110 is middle market. If it moves up $1, we're going to be looking at this premium being $1.44, okay, after that first dollar move. Vice versa, you can see over here, delta is negative in this column. It's on the put side, and it's on the assumption of that $1 move higher, okay? So that's why it's negative. So we would subtract this 47 cents from, say, $1.86 in this, or $1.87, because that's about middle. So we subtract the 47 cents from that, and on that first dollar move higher, we would have $1.40 afterwards, okay? Now, if it went down by $1, so let's just say market goes down by $1, right? So now we're at $66.62, all right? So we've gone down by $1. These premiums, a negative $1, right? That puts a negative plus a negative. Now this delta becomes negative, and we would have to subtract it from those premiums, all right? And again, vice versa. You say a negative plus a negative equals a positive. So that would be a positive 49 cents to the premiums over here, okay? So pretty easy to think about it. That first dollar move, a negative plus a negative makes that a positive, or a positive plus a negative is a negative over here in the puts, if you're thinking about the put side there. Pretty easy on this side. If we're going down $1, it's a negative plus a positive is a negative to that. So first dollar move on delta is how it affects the premium. Now, if we look over at gamma, you can just think of gamma as being something that goes with delta. So gamma goes with delta, right? And gamma really is the second dollar move, all right? So when we go over here and look at the option montage again, and we're looking at that second dollar move, we can look at Gilead Science, just for lack of a better one to look at. And we talked about this one. If we're at $1.10, right in the middle of the market, this goes up to now we went from 67.65 to now we're at 69.65, okay? So that first dollar move, we saw this premium increase from 110 to 144, right? So that was on the first dollar move. So that's on $1. It's going to equal that. Now on the second dollar, gamma goes with delta, all right? So we add in the gamma to the delta, and now we're at 41 cents. So that totals out to be 41 cents, right? So the second dollar move higher, so on dollar number 2 higher, our premiums are going to now be $1.85, okay? So that would be on a $2 move higher. Okay, vice versa. Gamma goes with delta on the first dollar move. This gamma adds in to the delta as a negative. So we are adding gamma to the delta. So in that first dollar move, actually that first dollar move higher, we've got a negative plus a positive. So the gamma would subtract out of that for the second dollar move higher. So that second dollar move higher, we would only be looking at it decreasing by 39 cents, okay, for that second dollar move. So those premiums would, on the second dollar move, decrease by 39 cents. So the first dollar move, we were looking at $1.40, right? And that was on $1 move. It's $1.40. The second dollar move, it would look like $1.01 on the second dollar. Does that make sense to everybody so far? So gamma goes with delta, and vice versa. If it was negative, right? If the went down by $2, then the gamma would actually negative plus a negative is a positive. This positive would add into that. So these would have increased by that 57 cents. Okay. So think of it that way. A negative plus a negative equals a positive plus the gamma, and then that all adds in together. Okay. So all of those math that you learned in second grade actually come into use at some point. You thought it may never come into use, but it does. All right, theta. Theta is the thief, all right? Think of theta as the thief in the night that comes and steals your premiums, all right? It's the impact of premium, or the impact of time on your premium. So when you're just looking at it, we have to look at it as each day goes by. So tomorrow, we can look at the theta. The theta comes out of our premium 2 cents every day. Now, one thing to note about theta is it starts getting a little more aggressive the closer we get into expiration. You can see theta is now 5 cents. So think about theta is when it hasn't really found out about your options, when we're way out in time, we can see that theta isn't very aggressive. He's a little bit nervous about stealing your money, but then once it comes in a little bit closer, you can see a much more aggressive theta. So theta starts out real slow, and I've got a better graph of this, and starts really picking up, you know, inside of this area, okay? So it really starts getting aggressive the closer to expiration, all right? So theta is your thief in the night that comes and steals your premiums. And then we go over and look at Vega, all right? Vega is just volatility, all right? Pretty simple. Vega is volatility. They just always come up with fun, creative Greeks to try and confuse people. But all we have to do is remember is Vega is volatility. And all that tells us is when we're looking at Vega, it actually affects further duration. So let's just look at these. Affects further duration more so than the nearer duration. You can see it's much less, all right? But what Vega also tells us is that when this number right here goes from 2704 to now 2804, we can see that this volatility coefficient over here, 9 cents, adds in because it's positive. It adds into it. Whether the market goes up or down or sideways, it will add into the premium, all right? We're forgetting about the delta and the gamma on all of these right now. Delta and gamma really we aren't worried about. We're trying to narrow everything down to simplistics, all right? So if the only thing that happened was this increased up here by 1 percentage point to 2804, our premiums would have gone from 178, which is 178, 179, let's call it the middle of the road. So it goes from 178, and we add in that 9 cents, we're going to be looking at I got a little ahead of myself, $1.80, what did I say, 87 cents, okay? So that 9 cents gets added into it on either side. So these would also increase by the 8 cents at the same time. So we're looking at middle of the road being $1.14, then they would have increased now 8 cents to $1.22, okay? Does that make sense so far? So volatility is positive if this is positive. So positive plus a positive, we're going there. Now, if it was also to decrease from 2704 to 2604, then we would look at this is a negative. So it went negative 1%. So a negative plus a positive is a negative. So the negative 8 cents would have come out of this. So it would have gone out from 114 minus the 8 cents. We'd be looking at $1.06. All right. Does that make sense to everybody so far? And these would have been 178 minus the 9 cents. We would have been looking at 169 on the downside. All right. So pretty simple. Volatility, it's 1% every 1%. So, 10%, it would change by 90 cents over here, right? Over here, 10% increase, then these would have increased by 80 cents to almost $2, right? And that's usually more important. One of the beauties in this strategy is, I want to just make you guys aware of this. We are going to basically be able to negate all of these. We're not going to have to worry about any of these. Why? Because of the way we're building up this strategy. But I do want to make you guys very aware of this in the beginning, because if you've signed up for this course, we are going to be talking a lot about all of these. So you do need to know those. But if you are a new option trader, I want to make you aware of them. But just know with this strategy, the only thing we're really going to have to worry about is delta and how it affects our premiums. Okay, so we've gotten that one down pretty good. So we will move on with that. And like I said, we are doing this one on the synthetic short stock. And with this synthetic short stock, what do you guys think our assumption is? It's just like a short stock. So our market assumption is going to be, I don't know why I did that. Our market assumption is going to be bearish. And you have to be really bearish. Yes, KM was all over it. You have to be really bearish. Like, you expect this market to tank, all right? We don't want it really to, it doesn't hurt us if it trades sideways. We're not going to make any money on a sideways market like this. We actually want something that looks like it wants to trend down. After today's news, it's probably not going to be the SPY, but we can find something. Like I said, there is always a bearish market out there. There's always somebody that is struggling in any given market, all right? Whether or not, money managers moving from utilities into financials or something like that, there is a bearish market out there. Or if the equities are moving higher, we usually see bonds going down, right? Or gold going down. So those are always opportunities we should look at for our portfolio, because the market doesn't always just go up. There's not always just a bullish market out there. All right. So when we're building this, we're going to sell the at the money, or as close to at the money call as we can. And then we're going to be buying the at the money put. These are the same strikes. All right. So we are going to be looking at the very same strikes to build this strategy out. There's no difference, despite the fact that, I've got them on different lines. It's really just to give you an idea that we're just selling the calls at the money, and the same strike, we're going to be going out there and buying that put. Now, with that being said, what we're going to have is, the reason why it's a synthetic short stock is because it has the same risk parameter as a short stock position, all right? Just like the synthetic long stock is the same risk parameters as a long stock, all right? There are benefits to using the synthetic stuff. One of them, with the risk profile, our profit, max profit is achieved when the underlying goes down to $0. Now, I'm not expecting anybody to hold on to any of these trades till it goes down to zero. However you come up with your bullish assumption, you should also have probably a price target on the downside, just like I talk about on the upside. We have price targets on the upside. I don't ride anything out forever. I have a short-term price target for things, and that's what I look for. And once that's achieved, then I'm looking to exit out of it. But I need to let you guys know all the real risk parameters here. And max profit is when it goes to zero. Your max loss is infinite, you guys. If this market goes straight up, somebody solves cancer, then this could go to infinity, all right? Just like any other risk parameters. But, you know, we need to have our level where we are out, okay? Oops. Where we get out, okay? So I'm not waiting for it to continue on up, you know? Or if your assumption changes, even before it starts going back up, you know, get out when your assumption changes, all right? You get that gut feeling. I talk about that a lot. I said I started out trading with a psychology degree. When I went on the floor and started trading, I said that psychology degree was more important to me than my financial degree. Actually, you know, my finance degree was pretty funny because the guys on the floor would actually ask me what the numbers meant to the market. So that did help out. Don't get me wrong, but the psychology of the market, like staying mechanical, knowing to take the emotion out of this kind of lifestyle is really important, you guys. Take the emotion out of it. And some of the ways to take the emotion out of it is knowing where you're getting out for a loser and knowing where you're getting out for a winner, okay? So that would be your happy face. You know, if it comes to here, I'm out. If it comes down to here, I'm getting out. And I don't care if it continues down to zero, all right? My price target or where I said I'm getting out is where I get out. I don't look back, all right? Never go back and second guess yourself because you're going to go back and be like, oh, I could have made more money. I could have squeezed it out for a little bit more. But I'll tell you what, I've seen so many times where people don't get out where they originally said, all right, because they think it's going to go down to here. And what happens? It bounces straight up, all right? So whatever tells you to get out, write that down. I'm getting out at this level and get out. Don't look back. Don't second guess yourself because the one time you do look back is going to be the time that it's going to end up hurting. All right, our break even, since we're using the same strike price, we don't have to worry about it. But if you get a credit, then you're going to add that in, all right? And all this is basically with the strike price plus the credit, that should equal where the underlying, where XYZ is currently trading, all right, where it's trading right now. You don't want to be selling this short way below where the market is. Otherwise, it would behoove you to just go out there and maybe short it. The margin would probably hurt more than the couple of pennies. But when you're pricing this out, you know, a lot of times when we're looking at options and stuff like that, you know, how do you figure out if the option is priced you know, appropriately? Well, for one, there's so many people trading options right now. They are priced appropriately. But one thing I want to make sure you're doing is your break even should equal where that underlying is currently trading or somewhere in and around that. A lot of times we will be able to trade this or implement this strategy above where the underlying is trading, all right? So you're selling it short above where the underlying is trading. So you're getting in at a very generous level that you would not be able to achieve elsewise, you know, or if you went out there and just shorted it, which is always a great thing if you can find that opportunity. I wouldn't say that's the opportunity just to short something, but there's times where you will be able to do just that. I don't know if I have any examples today or if we'll find one today, but just know that it is out there and never sell it below where the underlying is trading. Always try and price it out. And you know what? If you build out the strategy, look at where the bid offer is, where the underlying is trading, go right in between that with your option strategy. You will most likely get filled on it, even if those, even if it's a really wide bid ask. All right. So obviously we've gone over this. Our risk reward is equal to the short stock position. And I don't know why it's not letting me click on that one for that. You can see here, the purple line on the upside is where your risk parameter is for just shorting a stock. You can see as the market goes up with TLT, I use this because, you know, with the stock market moving higher, you know, trade negotiations, everything else, it looks like bonds are going to struggle to rally. But then when you look at this blue line down here, maybe I should change that to a blue. But if we look at the blue line on this bottom side, you can see that the way I built this out, and with that, I don't know if you guys can see this down here, but we used the same strikes in this and did TLT with a synthetic short. I built it out just like that. So you can see that the underlying is trading right here at 137.38. And when I built this out, what did I say? If you're getting a credit, you add in 42 cents to that. So we're looking at ours being, we're looking at ours being 137 plus the 42 cents. So I'm looking at 137.42 for this strategy. All right. So I'm actually building this out where I was selling it above where the underlying's last trade was. So that's an example of when you can build this out and get it slightly. I'm not saying you're going to get it $1 higher. You will most likely never get that much higher. But a couple of pennies, a nickel higher is something that is in the realm of possibilities. And going a nickel below where the underlying's trading is definitely a possibility also, but I try to avoid that if I could. All right. Now, the benefits of this, all right, is it's going to use 50% less buying power than what you would do as if you went out there and just shorted a stock. Now, I stuck with TLT. You can do this with ETFs. You can do this with stocks. You can even do it with the futures, to be quite honest. So but you're going to use 50% less buying power. And I got an example here is if we sold 100 TLT, which, one thing to note, selling 100 TLT is equal to one option. Anytime you're doing options, it is assumed that one option is the equivalent of 100 of the underlying, okay? So if we sold 100 TLT at $1.3731, well, if I do this same strategy down here, you can see that my buying power effect is $6,865. Well, down here, it is less than half, all right? More than 50% less buying power effect. So benefit, you have a smaller portfolio. You have a lot of stocks in there. You don't have a lot of money on the sidelines. Well, why go out there and short a stock for that, whatever margin you have to use? It's usually like 50% the cost of what the underlying is. But why go out there and short that stock and take up all that margin in your account when you could do it with options with much less? That allows you to create more diversified portfolio. If you were doing this with synthetic longs, yeah, you could create with a $100,000 account, you could buy twice as many stock as you could otherwise, all right? You're not going to get the same, you're not going to get the dividends on the longs. And on the shorts, you're with the synthetic short, you won't have to pay that dividend. When you actually short sell the stock, you have to pay some of those dividends as well. So if they're paying out one, all right? And one of the benefits of using less buying power is that your return on capital is much higher. Think about it. If I risked only $3,000 versus $6,000, my reward is the same because we are going, our portfolio is going to increase dollar for dollar for every down move, but we put up less capital. So a lot of people like to look at this because, it shows how much they can leverage their account out, all right? How much more buying power, or in this sense, more leverage you could do towards that strategy. And another benefit is going to be you avoid borrowing costs when you're shorting a stock. Usually when you short a stock, you have some other ancillary borrowing costs that go in and around shorting that vehicle, right? All right, so what's this good for? It's good for overbought stocks. Think about it. If you had a parabolic move in something and you're just expecting something to come back down to maybe, let's say it's the 38 Fibonacci or something like that, you're expecting it it's gone too far, too fast. It's got to have a correction. People are out there dying to come in there and cover some of those longs from a long move. If you have a bearish assumption in something, however you come up with your assumption, you have a bearish assumption. I'm talking about TLT in these examples, which were pulled off today. Bearish assumption in TLT would be because the equities are moving higher. Maybe we have a bearish assumption in gold because we think that those gold bugs are going to move money out of the safe haven of the precious metals and start moving it into more risky assets. All right. So those are the levers and pulleys of the markets. Maybe you're looking at it that way. Maybe you've just seen something that is just trending down. Just not, they're just underperforming over time. You maybe see a market where it's got, lower lows, lower highs throughout, and you're looking at it trending down. Something like we could say Boeing with what it's recently been going through. All right. I tried to use Boeing as an example on the bulls last week. Everybody shut me down. They were like, are you crazy? Pairs trades. So for instance, you could look at Caterpillar and Deere, and these actually have been, Deere's been moving up while Caterpillar's been somewhat bearish. So if you wanted to get into a sector and saw something outperforming another, or maybe you just like Deere and you don't like Caterpillar, all right, you could put on a pairs trade, and this is good for your portfolio. Maybe you're long a portfolio that has a lot of Deere in it and it's made a big move, but you don't want capital gains on it, all right? And you think it might still continue higher, but you see something else in that sector that's not doing so well. Well, that would be the opportunity to come in there and do the synthetic short stock. So a great one for pairs trading and, hedging your overall portfolio. If you are, everything is just long in your portfolio, well, anytime I get very long where you're just completely long deltas, I always want something in there, maybe 1 out of the 5 or 1 out of the 10, something in there to give me some protection on the downside, something that I can capitalize on a downward move. So I'm always looking to hedge, and sometimes I actually get too short in my portfolio, and then start looking at this for delta hedge is what we call it. You're delta long here, so you need some short deltas, right? Because remember, with deltas we were talking about, right? If you're delta long, you're all to the upside, just like we saw with the calls. They were all delta longs, right? If you're long all of those, then sometimes you need to short something, get some hedging opportunities in there. Or I just jumped over this, a portfolio delta adjustment, which is kind of what I just talked about. If you are all long stocks in your portfolio, this is something that should definitely be considered. All right, now just a refresher, we're selling the at the money calls, we're buying the at the money puts on this XYZ stock. We got XYZ and we have a bearish assumption. We're a bear in it. So XYZ stock, we're bearish. We're looking at the synthetic short stock because I don't want to put up all this margin for going out there and shorting this stock and paying all those maintenance fees and everything else. So what we're going to do is look to sell an at the money call and buy an at the money put. But we need to know a couple of things to be successful with this. One of the things is picking the right underlying. Now, with this one, we're going to be able to neutralize the picking the right underlying. But what I usually talk about with trading options is, AutoZones out there, even Aon, are stocks that get a little bit wide. What is it? Restoration Hardware is another one everybody's heard of. It's that big furniture store, right? High end. Well, a lot of people have heard of those, but they may even trade the stock. They may even trade the stock a lot. It has a lot of volume there, but it doesn't convert over to the options. So in that case, we need to look at something that if it is a stock that is less than $100, all right, we want that option montage with 35 in the option montage. We're looking at 35 days to expiration for this rule. We want it to be less than 10 cents wide to the bid ask, all right, from the bid to the ask. All right, if it's greater than $100 stock, then all we're going to do is move the decimal 3 ticks to the left like that. In this case, it would be 10 cents, all right? If it's a $200 stock, so if it was $200, then we just move it 3 ticks to the left and we look at 20 cents wide, right? Something like Google, it's a $1,000 stock. We move it 10 cents or 3 cents to the left, or 3 decimals to the left, and now we would look at the bid offer should be about $1.10, all right, to the bid ask. All right, so picking the right underlying here, I'll pull up a platform. We'll show some examples of it. All right, Gilead, we got up. I've got 35 days to expiration, so that's as close as we're going to get, right? Now, sometimes it's going to be the spot month is really what we're looking at. This is the month where the most time and volume has been spent. There's not as much volume and open interest going on over here. 8 days to expiration. A lot of people are moving out here, and this is where all the eyeballs are. Now, sometimes there's 15 days to expiration, and we're going to be looking at 45 days to expiration for this rule. So as close to 30, the closest to 36 or 35 days to expiration is what we're looking for, all right? So closest 35 days to expiration, this stock is less than $100, so we're looking at this as less than $100 stock. So our rule is it needs to be equal to or less than 10 cents wide. So we're looking at these ones that are just out of the money. I'm not looking at these over here, all right? We want to look at these that are just out of the money, all right, on both the calls and the puts for the most part. I just always have a tendency to default to the call side. But we're looking at all of these, and you can see that they fit that rule. Now we could look at something with a, a little bit bigger, and we could go over to Apple, which we know there's probably a lot of volume and open interest going on it. So we can look at this, and we move the decimal 3 ticks to the left. So we go 1, 2, 3, and we're looking at 27 cents. So we go down here and look down and go in between this. And this is also during open market operations, you guys. So Apple, you can see, is 25 cents wide over here. Well, during open market operations, you guys, these markets are going to be much tighter. And that's where this rule comes into effect. It's not after the close or on a Saturday when you're doing your market research, or Sunday when you're doing your market research, whenever that is, make sure that when you're looking at the right underlying, you are really looking at during open market operations when basically you got all of the eyeballs looking down on this market, all right? So we want to see when we have everybody having an eye on it, keeping track of their positions, putting orders in there. Because think about it, after the close, I don't know about you guys, but I don't leave anything in there overnight. I don't want that overnight risk. And as soon as the market closes, you hear cha-ching and or actually it's not a cha-ching, but you hear all of, or see all of those incrementally get canceled immediately after the close. So make sure you're taking advantage of that during, or looking at that rule during the open market operations. No questions so far? All right, the right strikes. Now this is pretty easy. I said we're doing the same strikes, right? Well, at the end of the day, we want the same strikes to equal 100 deltas. Now, why do we want 100 deltas? Well, because remember, I said if the underlying moves up or down by $1, right, where XYZ goes from, if you had shorted this stock, goes from 100 to 99, well, that's a $1 move, right? If you had shorted XYZ at 100 and went to 99, you would have made $1 for every contract you sold, right? Well, the same with this. Delta, remember, it affects those premiums. If we only have, let's say, 35 deltas, well, if the underlying moves down by $1, right? Well, we only get 35 cents out of that dollar, All right. So we want to build it up to where it is close to 100 deltas. Now, sometimes it's going to be 99.65 or whatever. Sometimes you'll actually get it to build out to be 101, which is fine. You just want to get it to as close to 100 as you can so that it performs the same way as the underlying, as a short, as 100 of the underlying. Okay. Actually, here, somebody's throwing, I'll show an example of that. All right, so when we're looking at this one, so let's look at Apple just for lack of a better example right off the bat. So if I wanted to short Apple, we're going to look at the closest to the at the money. So we could, it's fair, the 271.50 is the closest one is going to be this strike right here, which is the 270 strike. So remember, we talked about this. We are going to sell these. So we're selling this delta. So we're getting short 55 deltas, right? And then we're buying this put. So we're buying a negative, which is a negative 45 deltas, right? So that equals our 100 deltas, right? So that would be equivalent to going out there and shorting this underlying. So if I can pretty much go like this, if I were to sell XYZ, you know, I'm getting short 100 of Apple. Now, if I go out here and do this, and I'm going to sell the calls and then buy the puts. Come on, scroll for me. And then buy the puts, right? So if I look at it, every one lot is equivalent to the underlying, or 100, right? So this would be saying I'm shorting 100 Apple. We can go over here to the Analyze tab real quick, analyze that trade. And I've got something else in there, so let's forget about that. You can see that it will perform the same, and your deltas are just slightly off, right? This is what I was talking about. It's not always going to be exactly 100, all right? Now, I did something wrong with setting this one up, and that's the duration, all right? One thing we want to look at is the right duration. Well, you know, if you have a very short-term outlook on this, I actually have a buddy that does trades, and he has a time stop on his. He's like, if it doesn't start moving in my assumed direction within 5 days or something, I'm pulling the trigger on this trade. But the right duration for this, if you're looking at this as being a long-term trade, delta adjustment, or however, the thing I always say is go out in time to give yourself enough time to be right. You know, the last thing you want to do is, not that, I want the other platform. The last thing we want to do is only have 35 days, right? Like if our price target, we go over and look at the price target and I expect it to come down to there, thought my pin was going to work for me. If I thought the market was going to come down to 228 for whatever reason, you know, I don't want to just only have this much time to be right. You know, it could immediately start rolling over and doing this, you know, and just continuing to go down, right? Which is what we see a lot of times. You know, you could see that this one took a lot of time to make that market correction, right? So the last thing you really want to do is, if you have that price target, not give yourself enough time. And yeah, you might have to pay, you know, a little bit more in margin, you know, for that longer duration, but it's not going to be much. You're still going to be able to build this strategy out for 50% less than what it would cost to short that underlying. Okay. So give yourself, you know, the long duration. And I'm not saying 200 days, but I'm usually looking at greater than, I was going to say plus 100 days to expiration is usually where I'm looking at. Now, if we are implementing the strategies with 100 plus days to expiration, when I talked about this picking the right underlying, that's still looking at it at 35 days to expiration, right? These markets and these long durations are going to be wider, right? and it's going to seem like, oh man, these are really wide markets. You know, how do I price it in? Well, just remember, we want our trade to be equal to where XYZ is trading, right? So make sure you just put it in between there, and you will most likely get hit on it, all right? If you sell it too far below where the underlying is trading, then somebody's going to come in there and buy that from you and then short the stock themselves and create arbitrage. We don't want to give anybody arbitrage. We're looking to take arbitrage out of the market. So make sure when you're doing this, you go to that long duration, just make sure you know it's equal to where XYZ is currently trading, okay? So that'll make your life a little bit easier, all right? And the environment, this is another one. Usually I'm talking about implied volatility percent here. Now, and I have rules for when implied volatility is really high and when implied volatility is really low. What we want here is kind of like middle of the road. And I usually say, you know, somewhere on a stock, if it's a stock, I kind of want that to be in around, you know, 30, let's say 35 to like 65, something like that, is usually the sweet spot for this. The reason why is because of implied volatility, and I should put a percent in there so nobody thinks later that, all right. The reason why is because if implied volatility percent is much higher, then there's better strategies. There's higher probability strategies than this one, all right? Anytime you're buying a stock outright, just so you guys know, if you're buying a stock, XYZ, your probabilities are 50-50. You pick the right spot, okay? Same thing with this. You're shorting it, your probabilities are about 50-50, all right? But there's other strategies out there that we talk about for implied volatility where it is usually one of the most important things we look at. That's going to be the thing that dictates really what strategy we use. So this one, we want something that's kind of middle of the road. And if you guys are wondering what implied volatility percent is, if we look at this down here and we're looking at XYZ stock, or it's Apple for this instant, you can see I've got a chart here. And some people don't even have the chart for implied volatility percent, all right? So I have it built out here. If you're on Thinkorswim, you can go over here and check it. Let me delete that. Pull all these a little bit closer. But right here, implied volatility percent, they produce it in a lot of different places. I've got the code that I throw in over here on the side. I think they actually started putting that back in there for people they had removed it for a little while. So if they've removed it, then let me know and I can help you out. But what we're looking at, if you don't have it, if you're on one of the other platforms and they don't have it, what you're looking at is you need 3 locations. You need the high, the low, and where the current's trading. So if we look at this and we look at the high, we can call it 51. The very low is, let's say it's, what is that, 18. So 51 and 18 are the high and the low. So what we want is we want the current IV minus the low IV, all right? And we take that sum and divide it by the high IV minus the low IV, all right? So in this case, we said we had 51, or sorry, that's not right. Let me erase that. The current IV is 23 minus the low, which I think I said was 18. And then we take that sum and divide it by the high, which is 51 minus 18. So basically we've got a difference of 5 divided by, what is that? 30, sorry, I got a dog snoring in the background. 5 divided by 13, or 5 divided by 33, that is going to be somewhere equal to, what is that? Goes in there 1, so 1, 2, so 1, it's like 11 or something like that. My math is going to be off. The thing to, you know, I'm just ballparking it too. So that is pretty low implied volatility for this. Now it will work on any given strategy, right? Or any given implied volatility, all right? Because one of the things with this is, remember, we're going to be buying one option and in the same strike selling the other one. So if you can look at Vega for this one, if I'm selling this one, it's a negative 34 volatility. So that means volatility comes out with a down move in volatility. Well, with that volatility over here, the one I'm buying, it's a positive, so it offsets, right? We've got a negative Vega here because we're selling it. We got a positive Vega here because we're buying it. The other thing is Theta, generally speaking, is completely offset also. We're going to maybe miss out on a penny or something like that, but we're not too worried about that. 1 penny a day on this one, all right? But that 1 penny isn't going to hurt us. The volatility, though, is the one that can really start to hurt us. And usually when you're going further out in time, which I talked about going out 100 plus days, these volatility will be offset as well. You can see across the board 64, and on the 70s is 63, right? And then the Theta is going to be offset as well. You can see it's 6 cents and 6 cents out here. So those are being offset. So that's what I was talking about. We don't really have to worry about the gamma, the theta, and the Vega on all of these, right? We can forget about those because they're offsetting, because we're going to be selling the calls and we're buying the puts, and you can see that those then offset on these different columns, right? Especially on the volatility and the thief. We're basically, as the Theta is hurting us on one of our prices, it's helping us in a sense on the other one, because when you're short a call, you want that Theta to steal your money, but on this one you want to retain it, and it's actually hurting you. So it's helping you over here, and it's Theta's hurting you over here, and they're offsetting. Okay, same with volatility, it's going to be offsetting as well. The one thing we do want to make sure is that we need to make sure, we want to make sure that we're getting as close to 100 deltas. And you can see that if we did the 270s, strike here, you can see that 45 and 55, those are going to be, we'd be buying these deltas. Buying 45 and selling 45, that'd be a negative 100 deltas. And if we even just decided to do these here, the 275s, well, you can see that we would still have those 100 deltas. So we're offsetting those nicely. All right, so, and then finally, know your exit strategy. However you get out of long or shorts, whether you're picking Fibonacci's and stuff like that, use that for your exit strategy. Write it down, just like I do with all of these keys to success. You know, the right underlying, I'm writing down X, Y, Z. All right, it fits the rules. What strikes did I pick? What was the duration I used? All right, what was the environment, just to keep an eye on it, right? And then tell yourself, before you implement this strategy ever, know where you're going to get out for a loss and or a winner. Now, I don't know exactly what your risk parameters are for a loss or a winner. Maybe you're like my buddy that you say, if it doesn't work out in 5 days, then I'm getting out of it no matter what. You can do that as well, but stick to your exit strategy. Write it down. I've seen it too many times, like that guy I was telling you about. You know, he says, I'm getting out here. The market came down to here, and he doesn't get out. Well, he thinks, okay, well, it's going to come down further. I'm going to squeeze it. What happens? It bounces. And inevitably, that's what's going to happen to you, especially when you haven't written it down. You're more likely to follow your exit strategy if it's written down, because you're holding yourself accountable, all right? All right, so this is the time of the webinar where I throw it out to you guys. give me some examples. I already see one, and we'll check it out. But we're going to go through this and just kind of go through everything to make sure I'm bearish in Apple for whatever reason. I don't have one that I can think of off the top of my head. But 35 days to expiration, we move the decimal, 1, 2, 3, make sure it's inside of 27 cents. We can see that's the fact. So I'm going to go out about 100 days because I want to make sure I have enough time to be right. Maybe you don't even want to go out that far. I don't care where you pick it. My idea is just make sure you go out far enough that you have enough time to be right. All right, so I'm going to be looking at the 270 calls. I want to short those, and then I'm going to go over to the 270 puts, and I'm going to buy those. I want to make sure my deltas are equal to 100. You can see that works, right? So I picked the right strikes. I've got 100 deltas. I've got the duration because I'm going farther out in time. Now, one thing to note, I said when you are doing this strategy, if you are building it out, you add the credit to this. Now look, if we add $2.23 to 270, we get 272.23. Well, where's the last trade? I'm actually able to sell this above where the underlying is trading. It's, theoretical at this point. I may very well have to go down and I would put it in here above the market, see if that works, see if somebody's mispriced something and I'm taking arbitrage. But it's likely that you can maybe get this, but put it in, count to 3, go back there, cancel, replace, move it down. If it doesn't work, cancel, replace until you, get filled, but don't go below where it's at. All right. You can take arbitrage out of the market. Don't create it. All right. So if you can sell it short above where the underlying is trading, that is great, especially $2, right? So take advantage of that. So that's how as simple as this strategy is. Okay. Don't overweight your portfolio with a bunch of shorts. I wouldn't suggest that necessarily, especially because we kind of just creating highs. But, I think it's great for a delta adjustment, a pairs trade, and all of those other ones. Somebody threw out DB. I think that's what you're saying, right? Deutsche Bank. So let's check Deutsche Bank. It's a $7 stock. We think they're going out of business. It fits the rule. It's less than $100 stock. It's a little wide on the insides, but you can see it's definitely fitting my rule on the outside of it. Let's get rid of that one. So we're going to go further out in time. They don't have those closer ones, so we'll have to go out to about 127 days. So we're going to sell the calls, 68 deltas. We're going to buy the puts, all right? So 68 deltas and 31, so we're getting 99. Just slightly less. That's close enough for government work in my eyes. As a matter of fact, if we pull it up on the Analyze tab, it might even show that it is closer to 100 than what this is showing. But $7.67, again, an example of when we can sell it above where the underlying is trading. Now, you may very well have to go down a little bit, but you might be able to still get this above where the underlying is trading. So if we are bearish in Deutsche and think maybe it's going to come down, your idea is I think it's going to come down and touch this line, or maybe we've got some Fibonacci's we can throw up. I don't have the Fibonacci. Why isn't Fibonacci working? There we go. So maybe you throw the Fibonacci's up there and you thought maybe it's just going to come down and test 7 or the lows. However you come up with it. Say I'm getting, I think it's going to come down here. Now what on your exit? Maybe it goes above the 200-day moving average, right? If it breaks above that 200-day moving average, I'm out. Write those things out. I'm out on my loss. I'm out on my winner. And put that down somewhere, whether you pull it up on your notes around your trade or whatever, which you can punch in, or on a notebook, which I have, and my wife yells at me because I have like a stack of notebooks where I still write down all my trades. She's like, can't you put some of those away? I'm like, no, I need that for data. Make sure I can go back and look at those trades and see what I was thinking during the implementation of this strategy, right? That's the most important, to make sure, you keep you remember what you were looking at when you first started with this. Now, this is what I was talking about. This is one I'm actually going to be looking at, despite the fact that in daily market commentaries I've been talking about bonds coming up here. I think with the economic data we've gotten, we've just heard the FOMC, these trade talks are looking pretty decent, you know. I don't know if I'm going to put it on before the weekend, but you can see we got, you know, a downward trending market. We've got lower highs, lower lows, all right? We got another lower high and expecting a lower low, maybe down to here, all right? So that, in my case, I'd write down, all right, I'm out at 131 on this one, right? And on a loser, if it breaks above this, which is 142, I'm out, right? So that would be my two targets. I'm 142 because it's written in there. I'm out on a loser, and then on a winner, I'm looking at 131. Oops, 131. All right, I'm out. So I'd write both of those price targets out and look for it to go down there and achieve it. Maybe it's even 133 because of the 200-day moving average or something, because that would just break below this low. However you're coming up with that, all right? So I would write those things down and look at it. So I'm looking at getting out there. I know my exit strategy, all of that stuff. Go over and look at the trade window. Let's get rid of this trade. 100 days out, you know, that's kind of the wheelhouse. Over 100 days or it's close to it. I could even go further out in time. And we're going to buy the calls, and we're going to, I'm going to do the 137s. Buy the calls, sell the puts. You can look at that. We're about 99 deltas, which is really close to 100. As close to 100 as we can get. Can we get 100 deltas out of that? No. So 137, we did a debit. So we're subtracting, right? Subtracting a debit from this, which would put me at 136. I would be selling this below where the underlying is trading. And most likely because it's going middle of the market and it's getting me really wide market. So I would crank this up all the way to make sure, I would make sure that I got this as a credit. Let me get it into the credit side. And I would say, you know, I want it to be middle of the road. So 50, I would say. Let's say 51. And I would put that trade in there because that's middle of the road. So anytime you're building this strategy out and you see that mispricing, you want to get it as close to where the underlying is trading up here. So build it out appropriately, especially when you're getting further out in time. These markets do get wider, right? There's still eyeballs out here. Believe me, there's people in TLT keeping an eye on this. And there's different spreads in there. You know, there's calendar spreads, there's diagonals that aren't being represented in here because the computers can't show a market that's leaning on a lean. And I don't want to get into that too much. That's really highbrow stuff. But basically, there's a ton of spreads in here. We all put spreads in there. There's millions of people out there putting spreads on in this market. So there's, you know, a Jan spread. There's a Jan March spread. There's a March April spread. Okay. Well, this March April spread, the legs can't lean on anything because this Jan is leaning on the D's. And so the Feb can't lean on the Jan because you can't lean on the lean, and the March can't lean on the Feb. And so there's pricing out there that's a lot tighter that you aren't actually seeing. They're not allowed to represent it because it's a lean on a lean. There's a risk there for that. Do you ever have time to go back to review your 2-year-old trades? But Penny, are you coming in pretending to be my wife? I do every once in a while, yes, especially if it is for XYZ stock, right? I know I've traded those. I'll go back there and look at those trades and see what I was thinking during that, see how the situation, the environment, and all of those things were associated, and see where I went wrong. Yeah, I absolutely do. Not all too often, but I do always have them right here at my side waiting to be looked at. But you know, within a year and stuff like that, I definitely will go back and look and see. You know, I mean, I can pull it up on the whatever it is when you go there and look at all your old trades. You know, that's a snapshot. You know, I can see if I made money or lost money, but I can't remember what I was thinking during that specific implementation, which is the important thing. Is what was I thinking during this implementation, and you know, if that's changed till now is what's really important, I guess. Okay. Does anybody else have any other questions? No? All right, in the chat window, you guys, then without further ado, I'll move on and close this out. I have this trading course special. Here is the link. I've also sent that link out to you guys in the chat window. We've been going back and forth in the questions box, but in that chat window is the hot link to this. It'll pull up a window for you, like I just clicked on. I don't know if it's going to pop up. I think it should. But this is the link, the options trading course. Here, it popped up over on this side. So this is it right here, the options trading course. You're getting over, you know, probably 10 hours here. And there's actually 50 extra hours in this one that I can pull up on that other one. But basically, volatility crush. I've talked a lot about volatility, how to take advantage of it. You can't really take advantage of it with this strategy, but there are ones that get in and out of other strategies much quicker, where you can calculate how much volatility can affect your premium on any given move. When you see, like, this stock usually has a tendency, when it's really high volatility, you get that crush. And how does that, how can I take advantage of all of that? So, and when volatility expands, you know, this will basically help you sleep at night. All right. Volatility can be scary, and I try to kind of negate all that for you so that you can actually take that and make it an opportunity. This is when we're trading and we're trying to come up with all these different metrics. I have different hacks, like the thief in the night, to help you remember different things. You know, that's the thief that comes. Different shortcuts so that you can streamline your process. I'm a huge proponent of Lean Six Sigma, and so all of these things will help you. There's 9 different hacks there. Options basics. These have some fun ones in there, but I also go through the option basics so that if you are a newer trader, you can take advantage of this. Even if you've been an options trader for years, I can tell you that some of my friends that have traded for years, like my buddy that has a time stop on many of his trades, you know, he could take advantage of some of the history of options with these option basics to understand them a little bit better, I think, because I don't always think that he has the right implementation process in and around options, and that will help you out. Learning to trade options like I do, you know, using the market profile, which is that blue thing on the side of my charts. I trade around that probably more than anything else. I do use Fibonacci, but I actually set up my Fibonacci to correspond with the market profile, and you'd be amazed to see how well it does. Also, gamma trades, how you can use gamma and just trade around that gamma trade. So that's more shorter duration, guys. You know, if you're like to get in and out, you don't like to be in for 100 days, you can use that. So, and how to make sure Theta takes helps you out. So, like, if you guys learned anything at all, you guys like how I teach. You know, there's a lot of people out there that can teach you how to trade options. I will be the first one to tell you, and I'm a little bit biased, obviously, but they are going to teach you the different things, like on those rules. When I go through selling short puts or selling short calls, I go through specifically in and around each one of those. You know, this is what you need. This is the best opportunity for it. What's the environment we need to implement this, and go through all of those steps to make sure you're setting yourself for the highest probability of success, right? I talked about this one with implied volatility. Yeah, we want to go middle of the road on implied volatility, because if implied volatility is super low, well, there's better option strategies out there. And I talk about that. As a matter of fact, I have, it's not an ebook, but I have like a chart where we can talk about it where I have a bearish assumption. Is volatility high or low? Well, it's low. Well, then these are the option strategies we narrowed down. Well, what's my duration on this? Blah, blah, blah. And it really breaks it all the way down to a strategy that you will find that has the best probability of success. All right. So with this one, we are very bullish. It's not bearish to neutral. Yeah, if it's neutral, it's not going to hurt us, but we are bearish and we have middle of the road volatility. So this is the best strategy for that type of situation. And that's why we're building it out that way. So like I said, if you liked how I teach, you should take advantage of this for $297. I've got that over there in the chat window if you're watching it live. And if you're not and you're watching it on tape delay, you're going to have to punch this into your URL there. The other thing is to look at the option trading course, which is pulling up somewhere. This one here, let's get rid of all that. So you get all of that plus the other 50 recorded sessions. So think about it. I mean, that is a lot of content that'll take you all the way into the summer. So each one of these probably has, 8, 10 courses, webinars that you can take advantage of. So hundreds of hours of content that you can take advantage of right now for a pretty cheap price, less than $300 that anybody can take on there. All right. So we've got that. One last thing I want to say is thank you guys all for attending. Let's see if I can click on this and get it to change windows. Got too many windows up right now that it won't change for me. Thank you guys all. Remember, other webinars, I'm going to be drilling down on different option components, trades I find, when and where I find them appropriate. Also, check out those daily market commentaries, you guys. I talk about every single trade I put on. I don't cherry pick. As a matter of fact, I talk about the losers more than I talk about the winners. Why? Because those are the ones we got to stay mechanical with. We got to break them down, make sure that we're lowering our cost basis on it, increasing our probabilities of success. If you've been watching, playing along with me, I had a McDonald's trade go against me, right, for earnings. I'm still in that trade. I'm lowering my cost basis. I've lowered it almost by $2 already. So I'm continuing to stay with that trade. And, because I'm still bullish McDonald's, despite the fact that they missed on earnings. I still think McDonald's is going to be around for 100 years. So I'm continuing to lower my cost basis on it and increasing my probabilities of success. Just want to thank you guys all. This is the link. Again, you'll have to, it's not a hot link though. The hot link's over there in the chat window. If you have any questions or comments or, a webinar you want to see me do something on, reach out to us, 310-598-6677 or trading@protraderstrategies.com. All right. That's all I got. I see a couple of things popping up there. I'll read those here in a second, but let me get rid of this so that you can see the trading on this. And yes, we want to get rid of you. All right. Trading@protraderstrategies.com. Again, hot link. And this is what you all get with this webinar. If you're watching it on tape delay, right there is the URL you'll need to type out. All right. That's about it. Other than if you can't take that, take it easy.